First of all, tax avoidance is sometimes used to refer to a legal reduction in taxes, whereas evasion refers to tax reductions that are illegal. Most of the international tax reduction of individuals reflect evasion, and this amount has been estimated to range from about 40 billion to about $70 billion a year. Tax havens can arise from either legal avoidance or illegal evasion. Evasion is often a problem of lack of information, and redeems may include resources for enforcement along with incentives and sanctions designed to increase information sharing, and possibly a move towards greater withholding. Avoidance may be more likely to be remediated with changes in the tax code. But what are the tax havens? Well, the OECD initially defined the following features for tax havens: no or low rates, lack of effective exchange of information, lack of transparency, and no requirement of substantial activity. The OECD created an initial list of tax havens in 2000, which would have treated firms incorporated in certain tax havens as domestic companies. In this list, there are countries from all over the world like Caribbean, West Indies, Central America, coast of East of Asia, Europe, South Pacific. The OECD subsequently focused on information exchanged and removed countries from a blacklist if they agreed to cooperate. OECD initially examined 47 jurisdictions and identified a number as not meeting the criteria for tax haven. It also initially included 6 countries with advanced agreements to share information. Over time, as more tax havens made agreements to share information, the blacklist diluted. Well, but what are the methods of corporate tax avoidance? If a firm can shift profits to a low tax jurisdiction from a high tax one, its taxes will be reduced without affecting other aspects of the company. Tax difference also affect real economic activity, which in turn affects revenues. One method of shifting profits from a high tax jurisdiction to a low tax one is to borrow more in the high tax jurisdiction and less in the low tax one. This shifting of debt can be achieved without changing the overall debt exposure of the firm. Now we will talk about the magnitude of corporate profit shifting. Studies made to analyze the profit versus the gross domestic product clearly indicates that the profits in the countries studied do not appear to derive from their economic motives related to productive inputs or markets, but rather reflect income easily transferred to low tax jurisdictions. Some studies have attempted to identify the importance of techniques used for profit shifting. The estimates for pricing of goods may, however, reflect errors or money laundering motives rather than tax motives. Much of the shifting was associated with trade with high tax countries. Thanks for watching.